All right. Hello, everyone. Welcome to today's live trading session. Now, if you're just tuning in and you can hear my voice and you can also see me, let me know in the chat your name and where you're watching me from. If you can see me, you can hear me, and you just joined this live trading session, welcome. And we're going to start by, you letting me know your name and where you're watching me from. Let's get to know you guys before we get started. We're going to use that opportunity to also wait for some other persons to join the session. But yeah, if you can hear me and you can see me, let me know in the chat your name and where you're watching me from. So whether you're new, and if you're new, you can also let me know in the chat. But if this is your first time, let me know in the chat. If you're a regular, participant of the Octa live webinars, welcome back. What we do here is we educate you on how to navigate through the Forex market. No matter how complex it can be, there is always a way out, a strategy that we teach you on how you can navigate through the Forex market. It's going to be a very amazing live session. I have a lot of amazing things to discuss with you guys. We're going to walk through that, but for now, still welcoming you guys, and I want to get to know the people that are watching me today. You guys are also gonna get to know me as well. I would introduce myself and tell you guys a bit about myself. But for now, let me know, guys, in the chat, where you guys watching me from. Today we're going to be talking about how to increase profits and minimize losses, and there are subsections I'm going to dive into while we get started, but I'll just go over the disclaimer. Any opinion, news, research, prices, analysis, or other information discussed in this webinar or linked to this presentation is provided as general market commentary and does not constitute investment advice. Now, before I even go ahead to talk about myself, let's look at the chart and see who we have here today. Daniel from Lagos, welcome, Daniel. Michael from Port Harcourt, Nigeria, welcome. Olajuwon from Lagos. Ebere from Akwa Ibom State, welcome. Ifechukwu says he's looking, or she's looking, I don't know, but yeah, they're looking forward to learning a lot here. Welcome. Shamim from India. Rocky from India, welcome. It's good to see that you guys are also joining from different parts of the world. Michael says it's his first time. He got informed through Twitter. Welcome. Welcome, Michael. Congratulations on taking the first step. This is the boldest step that, aspiring traders or aspiring successful traders take, to becoming successful. You've just completed 50%. And this is also for anybody here that's joining for the first time as well. Attending this webinar and other webinars is just a 50% step, which is huge. The other 50% comes from what you decide to do after this stream. Okay, but we're going to talk about that in the session. Jones from Lagos, Gidado, I'm watching from Nigeria. Welcome, Sadiq. Sharifu from Bangladesh. Guys, I'm apologizing in advance if I don't pronounce your name correctly, but yeah, welcome. Ricky from Indonesia, welcome. Yusuf from Nigeria. Someone says they can't hear me clearly. Let me know in the chat if you guys can hear me clearly, please. Let me know in the chat, guys, if you guys can hear me. I think the mic is good. I don't know, but let me know in the chat if you guys can hear me. Uchenna from Bonny Island, that's in Rivers State. Welcome. David from Asaba. Guys, welcome. Okay, you can keep the comments coming in. Now I've got to know where you guys are watching me from. I'm going to tell you guys a bit about myself. My name is Ambrouse Ebuka. For those of you that do not know me, I have 6 years of trading experience and I've honed my trading proficiency and contrived various profitable strategies that include swing and scalp trading. Now, if you don't know what swing and scalp trading is, you're still going to find out in this session, but basically it's the different trading styles across different time frames, okay? I analyze gold, GBP JPY, and GBP USD charts with an outstanding accuracy exceeding 85%, and I regularly backtest trading strategies for effectiveness. Someone is still saying my speaker is low. And people are saying it's very clear. I don't know, guys. Maybe adjust your volume. I think everything is good on this end. Okay, so welcome everybody. Today, like I said, we're going to be talking about position sizing, right? How to minimize losses and maximize profits. And it's possible to do that. I'm going to show you guys, especially for those of you that are just starting trading, right? Usually you come into the market with a lot of excitement, but what really works in this market is skill. The market doesn't care about your excitement. The market doesn't even care about your goals. What the market and what your trading account is going to respond to is your skill, your dedication, your discipline, all that. Okay, so for today, we're going to be talking about position sizing, diversification, real risk management strategies. I'm going to teach you guys how to manage your risk, because what it does is it helps you stay long in the market to take more trades. And this is for every trader, but mostly for the beginner traders. When you get into this market, you need confidence. That is what is going to keep you in this market long enough to make more trades and potentially make more profit. Now we're about to get started, but before I do that, let me know in the chat, what's one thing you're looking forward to learning today? What's one thing that you're looking forward to learning? Let's say this live session is going to last for about 45 minutes. Let me know in the chat one thing you're looking forward to learning today. Let me know in the chat, guys. What's one thing you're looking forward to learning today? Let me know in the chat. Favor says it's the first time. Welcome, Favor. So, guys, the session is going to last for about 45 minutes. Use the YouTube live chat to ask questions. I'll be checking the YouTube live chat to see if you guys have any questions for me, and I would answer all your questions. Hillary from South Africa, welcome, Hillary. But we're still on the question, guys. What is one thing you're looking forward to learning today? Okay, TM says improving my psychology. Definitely, definitely. You know, I like to tell traders that risk works hand in hand with trading psychology. Like your risk management also works hand in hand with your trading psychology. Joshua says he wants to learn how pips, what they mean exactly. So obviously today we're going to be calculating lot sizes. I'll show you guys how, you know, obviously position sizes are also known as lot sizes. I'll show you guys what they mean, and you learn about how to calculate them as well. Olajuwon says he wants to learn how to improve his trading skills. Ebere wants to know about doji, which is the indecision candlestick. David wants to learn about proper lot size to use for a trading account. You guys came prepared for this session, and trust me, we're going to have an amazing session where I'm going to answer all your questions and give you guys, you know, practical illustrations and practical definitions of this thing so you can understand it better. All right. But right about now, we're going to go straight into today's session, and we're going to start with the number one thing on our list, which is position sizes. Now, if you haven't already, you can get a notepad, a pen, so you can write things down, and we're going to get started right now. So position sizing is the process of determining how much of a financial asset you should trade based on your account size, based on your risk tolerance, and based on your trade setup. It's also known as lot size. How many of us have heard lot size? If you've heard about lot size, let me know in the chat. If you've come across maybe an article or a video, a trading video that says something about lot size, let me know in the chat. John says he wants to learn about how to identify buy or sell trade. How many of us have trading accounts? If you have trading accounts, let me know in the chat, because I'm going to show you guys how to apply these things that you're going to learn today to your trading account. So if you have a trading account, let me know in the chat. After this session, you guys are all going to leave with a trading account, okay? It's going to be practical. So whatever it is you learn today, be sure to jot down, to write down, and also know that this video is going to be here on the Octa's YouTube channel. You can come back and rewatch for practice, okay? All right. So this is what position sizing is. It's like you're asking yourself the question, based on my risk tolerance, based on my account size, how much of a currency pair do I want to buy? how much of an asset do I want to buy? If you're trading, let's say metals like gold, you said, how much of gold do I want to buy based on my account size and my risk tolerance? Now, we're going to go to the problems and why a lot of traders make mistakes with position sizing. But before we get to that, let's talk about why it's important to understand lot size. Okay, so when I say lot size, I'm also talking about position sizing. Now, lot size is important, so lot size matters because it protects your capital in the sense that you can have a 40% profit rate and still grow an account, even if your drawdowns are small and your profits are big. I'll show you guys how that works with the calculation, okay? With proper lot sizing, or without proper lot sizing rather, one loss can erase all your previous profits. How many of us have been in a position where, we have an amazing week, we make a lot of profit, and then the next week we just lose everything? If you've been in that position, let me know in the chat. You had an amazing week or even an amazing day, right? You made a lot of profit, and then the next day you open a trade and then boom, everything you made gone. If you've been in that position, let me know in the chat. You've had an amazing week, placed a couple of trades, maybe on gold, maybe GBP, JPY, GBP, USD, and it was amazing. And then the next day you execute a trade and all the profits you made gone. If you've experienced that, let me know in the chat. Okay, I see some people saying they have. Now, we can both agree, right, that sometimes you can use good analysis, okay? You can use a proper analysis, you can use good analysis, but at the end of the day, the markets will go against you. That's normal. Losses are integral in Forex trading. What it means is from January up until December, right, it is not guaranteed that you're going to make profit from the 1st of January to December. But what you can control is your risk. Now, we both agree that you lost all that because you used a high lot size. Can we agree on that? Let me know in the chat. Can we agree on that? Can we both agree on that? Let's agree, right? Let me know in the chat. Can we agree that the reason you lost all the profits you made the previous day or the previous week was because you used a high lot size and you didn't use proper lot size? Let me know in the chat, okay? We're going to have, like I said, this is going to be a very interactive conversation. I'm looking at the comments because I want to engage with you guys and make sure that you guys are following and you guys are learning. So do well to use the comments and share your experiences because I'm going to be asking you guys a lot. Now I'm going to show you guys exactly how to calculate these things and make a good balance between the profits you make and the risk that you want to take on your trades, because it's very important, especially if you're just starting this market. Now, the second reason why position sizing or lot size matters is because it keeps your psychology intact. Now, like I said, when you get into this market, right, you want to start with confidence. You want to have confidence, especially if you're a beginner. You don't want to come into this market and you're already getting scared to buy or getting scared to sell. You want to come in with confidence. Using adequate lot size helps you build confidence. If you use an oversized position, it can lead to panic, it can lead to fear, you can become hesitant with your trades. But if you use proper lot size, even if your market is in a drawdown, you can still sleep at night. Not the one that you place trades and because you use the high lot size, then you're sleeping and you're dreaming about the trade. How many of us have experienced that? You sleep and you dream about your open position. Let me know in the chat. And the third reason is it allows you to stay in the business. By business, I mean the business of trading. As a beginner trader, your number one objective and as a trader generally, I keep saying beginner because I noticed, there are a lot of beginners on the call and people still want to learn, want to develop an edge. But generally, as a trader, your number one objective and your number one goal or your primary goal is to preserve your capital. Survival is rule number one. No matter how smart you are, you're not in the market if you run out of money. Now, the thing is, you want to make a profit, right? You would not be able to make a profit if you do not have money in your trading account. So you focus more on preserving your trading account. Let me know in the chat if you guys are following. Let me know in the chat if you guys are following. David said, yes, you can hardly sleep. Yeah, because sometimes you execute trades, and because you've used a very high position size, you start to become uncomfortable. It happens. But if you're following, let me know in the chat. All right, amazing. Now, here comes the calculation part of this session. Now, after this calculation, everything else that we've just said and everything we're about to say is going to make a lot of sense. Are we ready for some calculation? Let me know in the chat if you're ready for some calculation. After this calculation, everything else is going to make a lot of sense. Let me know in the chat if you're ready for some calculation, guys. All right, perfect. Now, the first thing you have to understand is we have three main types of lot size. We have the standard lot, we have the mini lot, and we have the micro lot, right? We also have the nano lots, but mostly and mainly three types, which is the standard, the mini, and the micro, because that's what you're going to be using while you trade. Now, this is the part where, we're going to also use our trading accounts for practice, okay? And you can do this at your own time, when you come back and watch this video. But just pay attention to this calculation. Now, we're going to start with the micro lot, okay? The micro lot has 1,000 units in buying power. 1,000 units in buying power. What this means is you can buy or sell 1,000 units of a currency pair. You can buy or sell 1,000 units of a currency pair. That's a micro lot. The value per pip on the micro lot is 10 cents. 10 cents is the value per pip for a micro lot. What this means is if you use a micro lot and the market moves 1 pip, that move is valued at 10 cents. If you use a micro lot and the market move 1 pip, the move is valued at 10 cents. And in your trading account, one micro lot is 0.01. So right about now, what I'm going to do is I'm going to go to the trading account. A second. Okay, so I'm going to go to the trading account. Yeah. And show you guys what I mean by that. All right, so let's say you want to place a trade. On, let's say, GBP, JPY. Now, if you look over here, you would see sell, buy. Right in the GBP USD rather, right in the middle, you would see 0.01. This here is called your position size or your lot size. 0.01 is, I think let me just ask you guys a question. 0.01 is what type of lot size? 0.01 is what type of lot size? Let me know in the chat. 0.01. We just talked about it right now. What type of lot size is that? Perfect. 0.01 is a micro lot size. Now, if you look at the table, you would see that 0.01 all the way down to 0.09 is a micro lot. The difference is 0.09 can be classified as 9 micro lots. Okay, so if I do 0.05, this will be 5 micro lots. If I do 0.09, this would be 9 micro lots, but it's still a micro lot, right? So let's say I do 0.01 and then we buy, right? If this market moves 1 pip, it can be anywhere, even if it goes below our entry price, right? But if it moves 1 pip below or 1 pip above, just like now, this is already 10 cents valuation, right? But you know that when you place a trade, the trade has to go above your entry price for a buy for you to be in profit, or below your entry price for a sell for you to be in profit, right? So right now, if this trade goes above our entry price, what's our entry price? If it goes above our entry price, which is this 1.16071, if you want to know your entry price, this is where you look at. If it goes above it, then it's valued at 10 cents. Okay, if it gets to 1.16061, you see it's changed to 10 cents because that's 10 pips away from our entry price. 1 pip rather, 1 pip away from our entry price. Okay, if it goes to 1.16081, that's 1 pip move and it will be valued at 10 cents for a micro lot. Okay, so all you have to do is just look at how many pips this is going to move. If it moves 2 pips, then that's 20 cents. All right. Now, if I do 0.05, right, let's say I do 0.05 and then buy 0.05. Now, each move will be valued at 50 cents. Remember, micro lots, each move valued at 10 cents. The same micro lot, but 5 micro lots valued at 50 cents. Right? If I do 0.09, 1 pip move will now be valued at 90 cents. Let me know in the chat if you're following. Let me know in the chat if you're following. Guys, if you need me to do the calculation again for you to understand, you can always let me know in the chat and I'll do it. All right? The goal is to make sure you understand exactly why position sizing or lot sizing matters and how to use it to manage your risk. All right. So that's for, okay, obviously, as you can see here already, this has already moved 1 pip below, as you can see, 1 pip below our entry price, and that's why we're having 90 cents. All right. The idea is to calculate the move, understand how it moves, understand what each move is valued at, and then you can use that to minimize your risk. Now, the next one is the mini lot. The mini lot is valued, or the mini lot has a buying power of 10,000 units. Now, what this basically means is you have 10,000 units in buying power. You can buy or sell the currency 10,000 units when you use one mini lot. The mini lot is valued at $1 per pip. What it means is 1 pip move for a mini lot is valued at $1, and it's represented as 0.10 to 0.99. So if we go back to our trading app, you'd see once we cross over from 0.09 to 0.10, now this has become a micro lot. This has now become a micro lot. Let me know in the chat if you're following. If you understand, let me know in the chat. So the mini lot stops at this, and then this is a micro lot. The micro lot has a buying power of 10,000 units. What we bought here was 1,000 units, 0.05, 5,000 units, 0.09, 9,000 units, and now 0.10 would be 10,000 units. And all the way up to, if you do 0.25, obviously you know that that's 25,000 units. If you do 0.99, this is also still a mini lot. All right, so let's say 0.10, and then we buy. Now you see the trade has been executed, and if this market moves 1 pip from our entry price, that 1 pip move would now be valued at $1. Remember, for the micro lot, 1 pip move valued at 10 cents. For the mini lot, 1 pip move valued at $1. I'm explaining this for you guys to understand exactly the difference between these lot sizes, because most times traders just come into the market and they execute trades. They just place trade with any lot size they want to use because they are more focused on the money than how much they are risking. Let's say, for example, I do 0.99, right? Still a mini lot, but now you see that 1 pip move will now be valued at $9.90. Can you see that? But obviously, I know you guys would ask the question, why is it that when I place a trade, and this is also a quick tip, so if you're writing down, you can also write this down. It's not really included in the position sizing, but you have to learn it anyway. Some of you ask the question, why is it that when I place a trade, it's automatically in a loss? That's because of the spread. I'm going to go to the 1 minute time frame and show you guys what I mean by that. That's because of the spread. Now, if you look here, you would see that we have the bid price, which is this red line, and we have the green line, which is the ask price, right? Now, the spread is this difference between the green line and the red line. So when you place a trade, for this buy trade now, the red line has to cross over. Once this red line crosses over our entry price, we're going to be in profit. This is the broker's cost of placing the trade. As you can see now, we've crossed over, and what happened? We're in profit. Can you see that? We've crossed over now and we're in profit. That's why when you place a trade, automatically spread has to be taken, and then you can now go ahead and secure your profit. All right, let me know in the chat if you guys are following. Okay, so that's for the mini lot, and then we also have what we call the standard lot size. Now, a lot of you guys use standard lot size without even knowing that you're using standard lot size. You just go ahead and put 5 lots, 2 lots, you know. But I'm going to explain to you guys what it means so that the next time you want to use 5 lots on your $100 trading account, you think twice. Okay, so a standard lot has 100,000 units. A standard lot has 100,000 units in buying power, which means with a standard lot, you can buy or sell 100,000 units, of an asset. All right. Now, one standard lot is valued at $10 per pip. One standard lot is valued at $10 per pip. What it means is when you use one standard lot, each pip move is $10. Let's go to the app and I'll show you guys. Remember, we had 0.99, which is valued at $9.09, right? Now, if we go ahead to use a standard lot, this is going to change to 1.0. And each move the market makes is going to be valued at $10. Let's walk you through micro, mini, and come back to standard. The micro, each move is valued at 10 cents. The mini, which we have here, 0.10, each move is valued at $1. Each pip move. And then we have the standard. Each move is valued at $10. Each pip move valued at $10. So let me ask you guys a question in the chat, right? If this standard lot size, this Euro USD, if it moves, remember each move is valued at $10. So if it moves 10 pips in profit, how much would be your profit? If each pip is valued at $10, what will 10 pips profit be valued at? If you know the answer, let me know in the chat. If you know the answer to that, let me know in the chat. Someone is saying the sound has gone low. Let's see what's going on with the sound. All right, guys, how about now? Is it good now? Okay. Is the sound still low? Let me know in the chat. Is the sound still low? Should be good now. Is the sound still low? Guys, I can hear myself and it's pretty loud. Okay. All right. So the micro lot, the mini, and the standard. Now, why I didn't talk about the nano is because obviously you won't be using that. One cent per pip. We're not going to be using that, and you can't even use it in your trading account. So, but just for the knowledge, right? This is it, just for the knowledge. So standard lots from 1.0 upwards. But let me know. I asked you guys a question, right? The question was, if one standard lot is valued at $10 per pip, right? And we have an open position here. One pip move is valued at $10 for a standard lot. One pip move valued at $10. So if this trade moves 10 pips, how much would be our profit? Let me know in the chart. If this trade moves 10 pips, how much would be our profit? Let me know in the chart. One pip move $10, right? 10 pip moves will be how much? David says $100. Joshua says 100, I think. So in the Forex market, you have to know. You won't make calculations or make trades based on what you think. All right. Okay. MJ says $100. TM says $100. Ashley says $100. Damon's $100. Correct. $100 is correct. 10 pip move, $100. Now, I believe that you guys understand exactly how to do the calculation. If you do not understand, please let me know right now. If you don't understand how to do these calculations, position sizing, lot sizing, you're going to need this when you're calculating how much profit you want to make, but most importantly, how much you want to risk. So let me know in the chat, do you understand it now? Okay. All right. So we're going to talk about common mistakes in position sizing. These are some of the common mistakes in position sizing. The first one is trading based on your emotions, choosing your position size based on your emotions. Right now, we just did a calculation, right? We just did a calculation right now about your trades. When you go to your charts, if you do not apply the calculation to your trading and you just trade based on, oh, I want to make this amount of money, oh, I want to make this profit, let me go big, you're putting your trading account at high risk. All right? You trade based on the calculation. You look at the markets and you say, this is my account balance, this is my risk tolerance, this is what the market is showing me, and this is how much I'm going to risk. Not, I feel like this trade is going to be a profitable trade. Let me go bigger. I made profit last week. Let me go bigger this week. Replace your emotions, replace your feelings with numbers. The second mistake that most traders make is using the same lot size on every trade. Using the same particular lot size on every trade. When you see market conditions require you to use a 15 pip stop loss here, and then you use maybe one lot size, right, for example, and then another market condition requires you to use 80 pips lot size, and you still go and use one lot size for that trade, you're putting your trading account at high risk. Because now one has $150 risk, but the other one, because you're using 80 pips lot size, would now have $800 risk. And that's dangerous for your trading account. The third mistake that traders make with position sizing is ignoring volatility. Guys, you have to understand that all pairs you trade are not the same. All pairs don't move the same. Gold doesn't move the same as Euro USD. GBP JPY doesn't move the same as AUD CHF. So when you use high volatile pairs like GBP JPY, gold, you want to use a moderate lot size. Now remember, when I say lot size, I'm talking about position size. They're the same thing. The fourth mistake would be stacking trades without adjusting risk. You place the first trade, you risk 2%. Second trade, 2% again. Third trade, 3%. Some of you even go as much as placing up to 10 trades. Now, if you already understand your risk tolerance and you understand how much impact this would have, fine. But if you're just starting with this market and you want to get familiar with your trading environment, you want to build confidence, you want to practice what you've learned, over leveraging and over risking is not the way. Think about it. What happens when this market goes against you? What do you now do? You fund the gain, right? Every single time you fund a trading account, it's like you're starting over again, but this time you're not starting over. Okay, let's use an example. Let's say a trader comes into the market today, they're excited about trading, they execute a lot of trades, maybe they fund like $100 account, and then they start to use two lot size, and they just go boom, 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 execute a trade, the account is wiped away. Now they fund another $100, but this time that excitement is gone. This time, you're now funding with less confidence. But when you risk 2% of $100, even if you take 5 trades and all those 5 trades were not profitable, you would only have lost $10. The goal is to stay long enough to practice everything you need to practice to become profitable. Guys, if you only had to fail 30 times to become a successful trader, won't you want to learn from that? So why putting so much pressure on a small account and trying to, you know, buy a private jet from it when you can actually use that account to learn, get confidence, and now start to trade with confidence, and you can even fund with more confidence? So I'm hoping that if you're familiar with these mistakes and you've experienced them, right, you want to go back to the drawing board. The truth is, you cannot move from being the trader you are to being a successful trader if you keep doing the same exact thing. It doesn't even happen in any aspect of your life. Aside, just even push trading aside, right? Just say, okay, outside of trading, my normal life, do you really think you can get to the next level if you keep doing the same exact thing that is stopping you from the next level? Now bring back trading, right? Do you really think that if you keep, you know, over leveraging, keep revenge trading, keep ignoring volatility, keep using high lot size on every amount of stop loss, think about the next 90 days. What kind of results would it get you? A good way to help you answer that is to think about the previous 90 days. So you have to go back to the drawing board and some things would have to change. Now, if you have any questions, please you can go ahead and ask your questions in the chat, right? I'm looking at the chat constantly to see if you guys have any questions and I'll answer your questions. TM says, stacking trades has shown me shiggy. Prince says, stacking trades and lot size has dealt with me. Prosper says, stacking has made me lose 2 accounts. Well, it's a good thing that, you know, you guys are being accountable for the mistakes you're making, because trading is one business where you can get away with not being accountable, right? So let's say you work in an organization. When things go south and you can't account for how money was lost, you report to someone. So it makes you accountable. While we're trading, you are your own boss. And that's why it makes it difficult for people to excel, because even if they lose a trade, they're like, well, it is what it is. Up next, you know? So it's a good thing to see that you guys are, you know, being a guys. And that is going to help you, you know, adjust on the areas that needs adjustment. We're going to talk about diversification right now and why it's important. Now, diversification is the strategy of spreading your trades across different assets, trade types, or time frames to reduce the risk of losing everything on one trade idea. How many of us have, you know, looked at Euro USD and we know how to trade Euro USD, but we're not seeing any confirmed setup? Then we go to ETH USD or we go to US 30 and then we see something to trade. How many of us have experienced that? If you have, let me know in the chat. If you've been in a situation where you don't see confirmation in a particular asset that you know how to trade, but then you go to a different one, do your analysis, and then you see confirmation. If you've experienced that, let me know in the chat. You have to understand that diversification, I mean, based on this explanation, you just think, oh, trading across different trading types, time frames, assets, but it's more than that. It's trading different kinds of risk in different ways at different times. I'm going to show you guys and talk to you guys why diversification matters. Okay, David says he has experienced that before. Guys, give me a second. Just trying to... Prince says it happens often to me. Now, imagine you don't know how to trade another currency or another pair, and you don't see, maybe you know how to trade Euro USD, but Euro USD becomes quiet. You know, there is no confirmation, and obviously you shouldn't just go ahead and make rash decisions because you want to make money. So what happens? You just wait the entire day out. This is why diversification is good, because now you can go to another pair and capitalize on what the market does at those pairs, how the market moves, capitalize on the same strategy that you use if it's a currency pair, and see how you can also make a profit. A particular pair is not always going to trend. A particular pair is not always going to give you confirmation. So you should be able to diversify. Number two, when your risk is spread across multiple pairs or multiple assets, if one goes the wrong way, it doesn't wipe your day. You still have space for other open trades and other open positions to perform, and then you hedge the damage. Number three, it creates smoother equity growth. By equity, we're talking about your trading account, your trading balance. That's what we mean by equity. So you're not just fixated on GBP USD every time. You're building a balanced, healthy equity curve. Okay, GBP USD is not doing great today. I can now trade Euro USD. I can now trade AUD CHF. So what are the types of diversification I'm talking about here? Because like I said, when I say diversification, it's not just limited to the pair, right? Or the asset. Someone said, so trading GBP JPY and CHF JPY is literally trading JPY anyways. There are other pairs. That's one. Two, it's not literally trading JPY if the base of the second pair that you're talking about is CHF. But again, there are still other pairs like Euro CHF, AUD CHF. As a matter of fact, I think I'm going to just go ahead and show you guys these pairs in the Octa trading platform, right? So let's click on Forex. Let's go to like the 4-hour time frame, which obviously I told you guys, you're going to learn exactly, you know, the diversification across different types, because it's not only about what's going on. It's not only about the asset, it's also about the time frames. I'm going to explain that to you guys. Let's give this some time to load up. Let's see if I can refresh. Okay. So back to, let's say, the 4-hour time frame. Let's go to the 4-hour time frame. Okay, so let's say for example, right, these are the currencies or the currency pairs that you can trade with Octa. You can see that there are a lot of options. If you want to also trade digital currencies as well, a lot of options. If you want to trade indices, metals, energies, and also some stocks, you have some stocks here: Meta, Microsoft, AMD. You can trade all that, right? But I'm not saying you should go ahead and just start trading random pairs without practicing or learning about how they work. What I'm saying is, instead of just focusing on one pair, when you understand one, you can now, let's say for example, Euro USD, you can now learn how to trade maybe AUD JPY because they don't even move the same. So this is what the AUD JPY chart looks like on the 4-hour time frame, right? You can see it's moving in what I'd call a range. So see it here. This is what's moving in. And you know that in a ranging market like this, we're going to get into like a 2 minute analysis. But yeah, in a ranging market like this, a breakout is imminent, right? It's definitely going to happen. In fact, the more the market ranges, the stronger the breakout. All right. So that's AUDJPY, but look at Euro US. So let's say you look at this market and you want to trade the trend, but you're not seeing anything to trade here, right? It's just ranging. Obviously, the only way you can profit from a range is if you trade the bounce. But from here to here is about 50 pips, which if you're going to be trading a 50 pip market, you have to be going to the lower time frames and risking like 5-10 pips to go for 50 pips. But for me, I like to look at the long-term possibility, the long-term potential of an asset. Oh, this has the potential of moving 500 pips. Now I'm confident and I'm comfortable to catch 100 pips, 200 pips out of that 500, right? So trade like this. Let's say you don't see any confirmation here. We're just, testing major resistance that we had since the beginning of the month, right? There's the major resistance from the beginning of the month. We're making a retest there. If you want to scalp some sales, obviously the close of this candlestick can be our indication to scalp some sales. If we close bearish and close back into the range, then we can look at the next candlestick for bearish momentum and capitalize on that all the way down. But while you wait for this, you can now focus on Euro USD and say, well, Euro USD is moving nice. I mean, nice pullback here. We just joined the buy trade and capitalize on some profits. The idea is not to just be fixated on one particular pair. As you can see, while dollar may tank from inflation data, gold might fly as a safe haven. The second type of diversification is strategy diversification, right? Use multiple approaches: trend trading, reversal trading, breakouts, mean reversion. The market, like I said, the market is not always going to trend 100% of the time. You saw what's going on with AUD. You saw what's going on with AUD JPY. It's not trading right now. It's not trending right now. If you go back, you'll see that we had downtrend and now the market is trying to reverse from this downtrend or this downward momentum here. Let's not call it a downtrend yet. We can just call it a downward momentum or a bearish momentum that has now turned back to the upside. So what I'm trying to say here is the market is not always going to trend up or trend down. Sometimes we'd have consolidations here like this. And then you want to know how to trade reversals. Okay, we're trending downwards. I've caught the trend. I'm seeing the market create some change of character. I'm seeing the market change its trajectory. And now I think we're going to reverse. I'm going to use my reversal strategies to look for confirmation and also ride this trade. Breakout strategy as well. If you want to trade the ranging market, like what AUDJPY is doing right now, if you understand how to trade the break and the retest. How many of us know how to trade the break and the retest? If you understand how to trade the break and the retest, where you get to see something like this, Then you see the market maybe push back up a bit and then down. This can also happen to the top side as well. And if it happens to the top side, we're going to get a strong AUDJPY break to the top. If you get a break and a retest, and we see the bears being rejected and buys taking momentum, this is going to push up for a bit, potentially all the way up to this point for another retest. We'll most likely get a fake out to the downside before we push all the way up to the top. But understanding how breakouts work can help you capitalize on this AUDJPY that we were saying, oh, there's no confirmation, there's nothing yet. But because you now know how breakouts work, you can apply that strategy to the pair. No single strategy works in every condition. Markets breathe in session, so your strategy toolbox should too. Now we have time frame diversification. Time frame diversification. This particular one can be optional if you're just a swing trader or if you're just a scalper. Because as a scalper, you may not be patient for long-term trading. And I like to tell traders, when you come into this market, right? Yes, you can learn a lot of things from mentors. You can learn a lot of things from, the webinars. But when it gets down to your actual trading style, you decide that yourself. Don't say, I want to be a swing trader because Ambrouse is a swing trader. You may not be as patient as I am in real life. You may not have a patient personality. And what happens? It creates some conflict between yourself and your strategy. That's why most people say, oh, trading goes against your personality. That's because you're an impatient person trying to learn swing trading. You may eventually learn it, but it takes some time. It will take some time. So you decide, okay, I'm a patient person. I can be patient here. I'm going to try swing trading. Oh, I'm not patient. I'm going to focus on intraday trading. Close my day, my trades within the day. For those of you that were here at the start of this session, I told you guys that I practically use swing and scalp trading strategies because that is me diversifying. If I go to the higher time frames, I know that this trade is going to last for weeks, probably up to a month or two. But if I come to the lower time frames, I'm able to catch some short-term moves and close the trade within the day. Whichever one you do, on the swing trading, focus on the 4-hour and the daily time frames. The mid-term setups or the intraday, focus on the 1-hour time frames. And if you're scalping, you're getting in and out of the market, focus on the 5 minutes to the 15 minutes time frames. Now, if you want to do that on your trading charts, this is where you go. You come down here. M1 is 1 minute, M30 30 minutes, H1 1 hour, H4 4 hour, D1 1 day. All right. Now, as a scalper that gets in and out of the market, you have no business with the daily time frame. You can only look at the daily time frame if you want to identify the overall direction, but you have no business with executing trades on the daily time frame if you are a scalper. Each candlestick you see here took 1 day to open and close. That goes against your understanding. That goes against your trading style as a scalper. As a scalper, you want to get in and out of the market on the lower time frames. So when you're learning strategies and you start learning daily time frame strategies or 4-hour strategies, it may not work for you. Let me know if you're following in the chart. But if you are a long-term trader, a swing trader, you can now apply short-term scalps and practice on that. It's easier to, or it's better to learn from the higher time frames than to just focus on the short-term time frames and you start to go to the higher time frames to execute trades. You would notice the switch very fast. Number 4, session diversification. You know, I told you guys when I talked about diversification, I know you guys were only focused on, you know, the time frame, not the time frames, but the assets, right? Oh, let's trade BTC, let's trade Euro USD, but it spans across the asset, the session, it spans across your trading style, your trading strategy, not just the asset. Trade setups from different market sessions. We have the London session that comes first in the morning, right? 8 a.m., 9 a.m., London session is active. The New York session comes at 1 p.m., 2 p.m. And then the Tokyo session comes in the midnight, right? 1 a.m. Nigerian time. All this I gave you was in Nigerian time. And then I say 1 p.m., 2 p.m. because of daylight savings, where the clocks are moved 1 hour forward and 1 hour backward, okay? But this is basically when these sessions are open. And obviously, you would know that the dollar would be active during the New York session, the pound will be active during the London session, the Japanese yen will be active during the Asian session. If you only eat what London gives you, it means you starve when London is quiet. So now we're going to talk about the 5 pillars of risk management. The 5 pillars of risk management. But before I do that, let me know in the chat if you guys are enjoying this session. If you guys are learning, because I'm going to ask you some questions at the end. But let me know in the chat, guys. Let me know in the chat. We're going to talk about the 5 pillars of risk management. Now, the first pillar of risk management is a defined and smarter stop loss. See the stop loss before you enter. Set it before you enter, not after you enter. Don't just pick random pips. Use market structure below, above key zones. You can use the ATR indicator to adjust for volatility. And you can even use a trailing stop. Octa has that amazing feature. It's called a trailing stop. You can add this to your trade. A trailing stop. You can say, okay, if it moves 50 points or 50 pips, put the trailing stop here, as you can see. Put the trailing stop for me if it moves this amount of pips. And now we have our trailing stop at this distance. So it's just going to be following it. So even if the market goes against you, you've already secured that amount of profit. Your stop loss should reflect logic, not just distance. Then the second one is risk per trade. Know your exposure. The beginner standard is 1 to 2% risk per trade. Now, I'm not saying when you get comfortable, you can't play around with your risk and understand how much you want to risk and, you know, potentially make more profits, right? But what I'm saying is if you're getting into this market for the first time, you have no business with risking 50%. Because what you want to build is confidence while preserving your capital. If you have high confidence setups, maybe 2.5%, you have to identify the news. FOMC is coming up, NFP is coming up. You put it down so that you don't get caught up in a spike after using an amazing risk and an amazing analysis. And then, you know, the chairman of the Federal Reserve, Jeremy Powell, he comes up and he says this, boom, 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 and boom, account's gone. You want to pay attention to the economic events and never use a certain amount of stop loss that is more than what you're capable of risking. so that even if the trade is on a drawdown, you're okay. I mean, you already know how much you're risking there. You know the next step. But most times, what traders do is you open a trade and then you're looking at the trade. You just keep an eye on it. Okay, it's $200 now. If it gets to $500, I'll close. And then what happens? That $200 profit turns to $100 drawdown, $200 drawdown, $300 drawdown, and you're still there looking. You're like, well, if it gets to $500, I would close it in loss. And then sometimes when it even gets to that 500 drawdown, you still want to adjust again and say, you just find one excuse around the corner and just build some kind of hope. Guys, I hate to break it to you, but hope is not a strategy in Forex. Hope is not a strategy. The third one is emotional risk control. Most of the losses you make doesn't come from strategy errors. Sometimes they can come from emotional errors. You have to identify it. Don't revenge trade. Set a daily loss limit, maybe 4% of your account. Set a daily loss limit. Let me know in the chat if you guys can hear me. Let me know in the chat if you guys can hear me. Okay. So don't revenge trade. Set a daily loss limit. When you have consecutive bad trades, take a break. And while you take a break, go to your journal and journal emotional decisions, not just the technical ones. I know most of you have a journal. You say, yeah, I journal my trades. I made a loss today. I wrote it down, -2%, -3%. You also have to journal your emotional decision. This is what made me take this trade. This is how I felt right after. And you have to ask yourself, am I trading my urge or am I trading my emotions? The fourth one is risk to reward ratio, RRR. Every trade should have a favorable ratio. The minimum you should ever do is break even, 1-to-1. Risk 1% to make 1%. That's the minimum you should ever do. If you're risking 5% to make 1%, that is not moderate. That is not moderate. Now let's do a calculation. So let's say I'll try to make this very, very fast. So pay attention. Now let's say you risk 1% to make 3%. 1% to make 3%. You take 5 trades. Out of that 5 trades, I think I'll just show you guys the illustration instead of just using it. Okay, so let's say you risk 1% to make 3%, right? 5 trades. The first trade was a 1% loss. Let's say you're doing this on a $1,000 account, right? So 1% loss, you're down 990, right? Second day, another 1% loss, you're down 980. Third day, another 1% loss, You're down 970. Remember, all these trades were 1% risk to make 3%. On the fourth day, you made a 3% profit. Now, you're back up at 1,000. On the fifth day, you made another. Okay, let's just assume you did a break even on the fifth day, right? Break even, no profit, no loss. That's what it means. So you took 5 trades, you made 3 losses, 1 profit, 1 no day trade or break even trade, and you still had $1,000. Capital was still preserved for the next week. Capital was still preserved for the next week. So you see, if you tell somebody that I took 5 trades, but I didn't trade once, and the remaining 4 trades I lost 3, they'll be like, wow, you're not a good trader. But then when you look at it, like, those 3 losses were just 1% and the profit was 3%. Now it begins to make more sense. Let me know if you understand it. Let me know if you're following. Now it begins to make more sense. And the thought of, oh, you're not a good trader now changes, because now it's like, okay, how are you able to make 3 losses, 1 profit, 1 no trade day, and you didn't still lose money? Risk to reward ratio. I'm hoping you guys remember the topic of today's session: how to maximize profits while minimizing losses. The last one, and in this, we're talking about the 5 pillars of risk management, okay? The last one is trade filtering. Only trade your A+ setups. I know that a lot of times you see some trades and you're like, I've not traded in the past 5. Let me just trade this one and see. A good trader doesn't trade 50 times a day. A good trader trades very well. You trade your confidence setup. You ask yourself questions before every trade. Does this setup fit my strategy? Is this a clean market environment? Am I emotionally neutral right now? Is this a trade I can take in front of 10,000 people? That's what I like to ask myself. Is this particular trade I want to take now, if there were 10,000 people watching me live, would I take this trade? If not, don't enter. Don't enter. All right, guys, we've come to the end of today's session. I believe that there was a lot for you guys to learn today. We talked about position sizing, risk management, also how to diversify your portfolio, right? Let me know in the chat if you have any questions. This is the Q&A session. I'm going to take all your questions. So let me know in the chat now if you have any questions for me. If you've got questions, please let me know in the chat. If you've got any questions, please let me know in the chat. And for those of you that don't have the app already, you can use the link in the description to download the Octa trading app. The app offers a wide range of trading instruments with low spreads, fast execution, and zero commissions. It also has various educational resources, 24/7 customer support, and a strong commitment to funds and data security. Now, this is just a bonus to today's session. You can use this promo code to get a 100% bonus on your deposit. Ambrouse E100. You can use the promo code to get a 100% bonus on your deposit. Now, I'm ready to take your questions, guys. If you have any questions for me, please go ahead and ask me your questions. Thank you. Okay, Michael was asking, please throw more light on stop loss and take profit. So stop loss is basically a price. Let me even just show you guys that. Stop loss is basically a price where you tell your broker, I have a buy trade on Euro USD right now. The trade has moved over 12 pips and I'm up $125. I'm going to click on the trade. I'll come up here. I'm over $125, right? And I'll show you guys why, the Octa trading platform is best for you. Now, I entered at 1.1613, right? I want to risk just $100 on this trade. So I change from price, asset price. Asset price is you type in the price of Euro USD where you want the stop loss to be, something like that. Distance in point, how many points? Maybe 60 pips. Profit is, oh, I want to risk just $100, which is going to be 1.8% of my balance. Percentage is also, I want to risk maybe 2%. I want to risk maybe 1%. So that's what stop loss is. Profit in dollars, we can say, okay, profit in percentage rather, we can say, okay, let me just risk 2% on this trade. Take profit is where you tell the broker, or you tell Octa that I'm on this trade, but I have a date tonight. I'm going to be out. Or I have a football match to watch. Or I'm going to do this, I'm going to do that. I'm not going to be on my phone. I want to secure the profit when I make $500. And then you click on confirm changes. And boom. Even if your phone is off, even if you're not online, Octa is going to close this trade for you when you've made $500 in profit. Or you can change it and say, I want to make 10% of my trading account or 5% of my trading account on this trade. And you click on confirm changes, boom. But obviously, these figures should be determined by market structure. All right? Let me know if I answered the question. Let me know if I answered your question. What is position sizing? We talked about it at the beginning of this session. You can watch this video again to get the definition of that. Is flipping good for beginners or trade with perfect strategy for good profitability? I personally don't think someone just getting into this market today should start with a flipping strategy. Usually, when you start trading, what you first learn is what sticks with you for a while before you figure out what works for you. And the person that starts with understanding market structure, understanding volume, understanding how economic events impact currencies would adapt faster than the person that started with flipping. Because with flipping, it's like 50-50, especially when you're a beginner. Nelson's asking, how do you get your entry price? My final point of entry is candlestick confirmation. I want to see candlestick momentum, and then I'm entering the trade. That's how I get my entry price. Is it advisable to start out trying to flip an account, say $100 to $5,000? Is it possible? Yes. If you're a beginner trader, is it advisable to start with that mindset? I think you should focus more on getting the knowledge and building confidence around the knowledge, not just taking $100 to $5,000. I hope you know that is not even 50%. That's not even 100%. So that's not even 200%. And it's not even 500%. So the knowledge will get you far. Please throw more light on SL and TP. I just did that. You can come back and watch the video. Nelson, I said how I get my entry price is candlestick confirmation, candlestick momentum. That's what I mean. So if I see that, let's say, for example, we created equal highs here, right? We created equal highs here, here, and here. And I want to trade a breakout. I need to see an engulfing candlestick that breaks out. I'd wait for a pullback. It can happen immediately. It can happen sometime later. And after that pullback, I want to see another momentum that takes us up and takes us out of the previous breakout. That previous breakout candlestick, that's the momentum I want to see. Takes it out, and I'm looking for more buy opportunities. That's how I get my final confirmation for entries. Joshua is asking, what is flipping? Let me know if you get me now, nursing. Joshua is asking, what is flipping all about? Flipping is like flipping your account, like turning your account to, from $100 to maybe $500, $1,000. But if you even do 100%, that's also flipping as well. Anything from making 100% of your account is flipping. Let's see. Do we have more questions? I'm going to ask you guys some questions now. Since I'm not getting any more questions, I'm going to ask you guys maybe 1 or 2 questions. Are you guys ready for my questions? Are you guys ready? Okay, so I talked about diversification, the types of diversification. Let me know in the chat, what's one type of diversification that you learned? What's one type of diversification that you learned today? What's one type of diversification that you learned today? I talked about 5 types of diversification, or 4 types, right? Yeah, 4 types. 4 types of diversification. Let me know one. What's one type? Let me know in the chat. While you do that, after this session, please take a moment to fill out our survey. Your feedback is essential for us to improve our future webinars. You can scan the QR code, or you can use the link in the description to give a feedback on this session. It's going to take just 1 minute of your time, guys. Now, back to the question. What is one type of trading diversification that I talked about? I talked about 4 types of diversification for traders. What's one type? Let me know in the chat. Okay, someone said diversification of lot size, diversification of sessions, time frame diversification, trading diversification of lot size. Douglas says he just joined the chat. Well, the video is going to be here on Octa's platform, so you can watch again and again and again. So the diversification, the types of diversification, well, thank you guys for actually answering. But I don't think I said anything about lot size. So we have asset diversification, we have strategy diversification, we have time frame diversification, and session diversification. All right. What you do with your lot size is based on your risk tolerance. All right. When you use a particular, that has to do with your position size, managing your risk. So let me know if you got it correctly. Did you get it correctly? Did you get the answers correctly? I'm already seeing some correct answers anyway. All right, guys, we've come to the end of today's webinar. It was an amazing webinar. I personally enjoyed it. I loved the fact that you guys were very, very interactive. This was amazing. I like to tell traders that you do not rise to the level of a strategy, you fall to the level of your discipline. Risk management is emotional control in action. Your growth in trading is tied to learning to act with precision. Don't aim to make profit on every trade. Just aim to trade well every time with your strategy, with your plan. And if today's session sparked something in you, maybe a mindset shift, maybe an aha moment, maybe a wake up call to, stop blowing your account and bleeding your profits, I want you to do two things. The first thing I want you to do is to apply what you learned today on your next trade. The next thing I want you to do is to share this session with one trader you know that is struggling silently. All right? My name is Ambrose, and I'll keep showing up to teach you guys how to navigate through the Forex market. Stay connected with the Octa Broker YouTube channel. This is just the beginning. And if you have any other questions, you can still ask in the chat. All right? Ask in the comments, and we'll do well to answer your questions. Thank you again for joining, and I'll see you guys next time.